Chapter 7, Part 3. Now what we're going to do is look at notes receivable. Now, what is notes receivable? A note is a written promise to pay a specific amount at a specific future date and normally includes interest. So this would be an example of what it might look like. Now, the one we're primarily concerned about is providing goods or services in exchange for a promissory note. Or if we decide to, if somebody can't pay their accounts receivable, they can convert it to a promissory note. But the thing you need to remember about notes receivable, since you have interest, you need to understand how we calculate interest. And the principal amount of the note, which is the original amount, times the annual interest rate gives you the annual interest, i.e. the interest for 1 year. But what we need to do is, if it's for less than a year, then we have to take it times the number of months divided by 12. So let's take a look at an example. So a customer purchased goods for $36,000. 2 months later, they converted it to a note due in 4 months at 6%. So the original amount is $36,000. That's called the principal. The interest earned is going to be $36,000 times 6% times 4 divided by 12 because it's only for 4 months. The total amount received is going to be the principal plus the interest, and that's called the maturity value. What is the note amount at the end of the period? Now let's look at some journal entries. So at the time of the sale, we're going to book the accounts receivable. At the time they decide that they want to convert it to a note, we have to take it out of accounts receivable and put it into notes receivable. What does it look like when it's paid? Well, first we take the notes receivable off the books, we book the interest, and then we show the cash, which is the total of those two. Now, when a notes receivable is outstanding at the end of an accounting period, like the end of the year, the company must prepare an adjusting entry to accrue interest income. Accrual accounting requires that we do this. So you issued a 6-month note on August 30th for $10,000 at 18%. How much interest must be accrued at year end? First, we got to figure out the number of days. You don't include the day the note is signed. Then you add up the months, and it tells you it's 123 days. We're going to take that times 10,000 times 18% divided by 360. Gives you 50 cents. So it tells us we're going to have to accrue $61.50. Now, normally I would have said divide by 365 since that's what you're using as part of coming up with the days, but that's not how they do it in your homework. So I want to make sure you do good on your homework. So this is what they do. So we're going to go notes receivable, accounts receivable. At the end of the year, we're going to determine the interest earned. So it's going to be $15 times 12 days. I'm sorry, that's how you get. You get $1.25 times 12 days, gives you interest receivable, interest revenue. We're booking it at year end. Now, what does it look like when we record the payment? Well, the total interest is $150, but we're going to take the notes receivable off the books, and then the interest revenue, and then we book the cash. And that ends this presentation. And then we book the, interest revenue, which is the difference between the 150 and the 15 we already accrued last year.